Hi there, I'm Pamela Ambler, your host for I See Your Trade. Thanks for tuning in. Welcome to the first episode of I See Your Trade, looking ahead with fresh insights and data-driven deep dives. On this episode, we are looking at interest rates. The great sugar hit of the last decade is ending. So how will markets across all asset classes respond when the cost of borrowing rises? I'll be joined by our guest, Richard Koo, Chief Economist for Nomura Research Institute, who's joining me from Taiwan. And we are going to be talking about how to navigate the world's fastest rise in global interest rates in 3 decades. Let's start by setting the scene. Inflation in the United States is the highest it's been since 1981. To put into perspective, the Oldsmobile Cutlass by General Motors was the top-selling car in the US back then. In the year 2022, it's an electric Tesla Model S. Circa 1981, a Cutlass would have set you back just under $5,000. The Tesla Model S has a starting price of roughly $95,000. Cars are a great barometer for inflation, with new vehicle sales making up the Consumer Price Index, or CPI, which is the benchmark that measures inflation. Most central banks aim to keep CPI within a range of 2 to 3%. But when CPI hit 8.6% in the US in May, the Federal Reserve snapped into action with a 75 basis point rate hike, and other central banks around the world scrambled to raise rates in lockstep with the Fed. The rapid and drastic rate hikes spooked investors, and around the world, stock markets plunged into the red. The message from central bank governors was loud and clear. The decade of cheap money was coming to an end. The $64,000 question is how fast rates will rise and by how much? And if rates rise this fast, what impact will that have on bond prices and currencies? And will this stunt global economic growth? Low interest rates tend to provide a tailwind for growth, so that means earnings and equity valuations may take a hit as rates inch higher. What does that mean for investors? Is the world on the cusp of another global recession like the one we lived through in 2008? And some are even beginning to yell the S word, stagflation. That's when you have a recession and inflation at the same time. The World Bank is sounding the alarm on stagflation, the likes of which we haven't seen since the 1970s. Back in the 70s, interest rates in the US and other countries got as high as 20%. Is the global economy heading for danger? Can the Fed orchestrate a soft landing? And with every downturn, there's always an opportunity. With everything in finance, there are winners and there are losers. Let's dive right in and unpack how this rapidly changing landscape is impacting stock markets, currencies, bonds, and economies. I'm joined by Richard Koo, who is the Chief Economist at Nomura Research Institute. Richard is a former economist for the US Federal Reserve and a world-renowned expert on monetary policy, in particular QE and QT, that is quantitative easing, and its close cousin, quantitative tightening. Richard, thank you for joining us on the VODCAST today from Taipei.
Thank you for having me.
I'm just going to jump right in. Inflation in the US is now at a 40-year high of 9.1% in June. How fast is the Fed going to raise rates? What's your prediction for where US interest rates will be at the end of this calendar year?
I think Fed will be raising interest rates quite quickly, because it has proven itself to be behind the curve on inflation. They got the inflation forecast wrong, and so they want to reestablish themselves as a true inflation fighter. And if you remember that they were just a deflation fighter only 6 months ago, it's a big change. And in order to establish themselves as a true inflation fighter, my guess is that they're going to raise rates pretty quickly and maybe well beyond what may be called the natural rate, because that's what's probably needed to convince the market that Fed is really an inflation fighter.
Inflation also is skyrocketing around the world. Argentina's inflation rate is tracking at about 70%, Turkey's inflation at close to 80%, and in the UK, price levels are at a 40-year high at almost 10%. How worried should we be about prices getting out of control, or do you see inflation actually peaking soon?
Well, a lot of people like to compare the current situation with what happened in the 70s. And 70s prices were going up very sharply. I still remember those days quite clearly. But there are similarities and differences. Similarities is with energy prices. The 1970s inflation were also driven by energy prices, oil shocks, OPEC, cutting supplies to the Western countries, and that really pushed the inflation rates higher. But the other part of what happened in the 70s is that it was basically an inflationary economy. Everybody wanted to borrow money, especially the industrial companies, because they wanted to invest, to build more cars, more appliances, and so forth. This time around, the energy part is the same. Energy prices are pushing prices higher everywhere. But are the industrial companies borrowing money to do all sorts of fixed capital investments? The answer is no. That is not happening, not in the advanced countries. And in the 70s, we all worried about not having enough savings. But this time around, actually savings are flooding the banks, flooding the financial sector, which is why interest rates were so low only 6 or 10 months ago. And so we have to be very careful about which part of the inflation is going to be going strong. And my guess is that energy price levels will remain high. There might be some slowdowns because of the global economic slowdown, but I think energy prices will remain relatively high. But the rest of the prices will eventually adjust to something more reasonable.
Certainly, we can attribute a few major factors for rising inflation. Number one is Russia's war with Ukraine. That's pushing up the cost of commodities, as you mentioned, especially energy like oil and gas. And the price of natural gas has soared roughly 700% so far this year. And just looking at the big picture, is it as simple as we solve the gas crisis, we solve majority of the inflation problem?
Well, I'm afraid gas prices is the big part of the inflation, and it might not go away very quickly. And that is because suppose you're the supplier of oil or natural gas, and then you're hearing people saying, no, we don't want to use those fossil fuels going forward, that they are not allowed to sell gasoline-powered cars after 2030 or 2035. If you're hearing all these very discouraging talk about the demand for your products, are you going to invest more in trying to get more of these from the ground? Chances are high that they will only do it if they are absolutely certain that within the next 5 or 10 years, they can get all the money back and still make plenty of profits. But that limits the number of projects they are going to do. But the demand for fuel, I'm afraid, is still very strong, and renewables are not enough to cover the demand. And so my guess is that energy prices will remain high for quite a long time, and that is what is probably needed to bring more renewables to come in. And so I'm afraid prices of energy will remain high for a while.
Yeah, and you've been quite vocal about the gas shortages and that we are seeing this impact of transitioning to greener energy generation. Is the current inflation, as you mentioned, a byproduct of the world's shift away from fossil fuels?
Well, so that's half of the story. And this part, I'm afraid, is not going to go away, because to a full conversion to renewables will take a long time. So this part could be with us for years. But the other part that started with supply chain problems, that will probably work themselves out over some period as people figure out that they perhaps overextended themselves on global supply chain. Maybe some of those products should have been produced closer to home. When those adjustments are made, that part of the prices will come down, but not the energy part.
Now, in a period of rising interest rates, growth stocks tend to be hard hit. That's because they're reliant on capital for future business expansion. And during periods of high interest rates, capital is more expensive and therefore harder to come by. And tech stocks, they fall squarely in that camp. For example, the NASDAQ 100 technology sector index, that is down about 30% this year to date. Is it time to steer clear of those exciting startups?
Well, you already said exciting startups. I don't think we should steer clear from exciting startups. However, what we had in the last maybe 5-10 years is that since so many people were not borrowing money, which is why interest rates were so low, only sector that was still in need of capital were those startups. And so the money was flooding Silicon Valley and similar areas all around the world. Those funds who could not be invested elsewhere were raising the prices of NASDAQ and so forth. That part will be going through correction now. Now that if you just hold on to regular corporate bonds, you still get reasonably good return. Now that bond market has adjusted, then they are in no need for entering the Silicon Valley at the pace that they were doing it just a few years ago.
And looking stocks as a whole, you've said previously that if the Fed Reserve Chair Jay Powell starts quantitative tightening at too fast a pace, he could be taking close to $100 billion out of the balance sheet, out of the economy each month, which could be a shock to the market. And this could go on for a while. So should investors steer clear of equities for the time being?
Well, probably less allocation to equities. But some companies were still doing well because the economy itself are doing quite well even at this very moment. The Jay Powell, the number you mentioned, close to $100 billion, that's already decided and they're already doing it. And if the Fed adds 100 billion of bonds into the supply, that's almost the size of US budget deficit per month. So the quantitative tightening that the Fed is doing is almost equivalent to doubling the US budget deficit every month. And that, of course, will have some negative impact on bond prices. That will push bond rates higher. And if everything remains the same, that will not be good news for asset classes, no matter which asset you are in, if bond yields are going higher.
Right. And there's also this growing fear that if central banks raise rates too quickly, it could bring the economy to a standstill, which the Fed is trying to engineer the soft landing. But going too slowly means inflation could snowball. So how do you rate the risk of central bankers coming down too heavy-handed with higher interest rate settings?
Well, this one is a very difficult one for the central banks who did the quantitative easing. And let me explain. Quantitative easing, they kept on adding reserves into the banking system. Massive amounts of reserves in the banking system. So bankers are all flooded with money. They cannot find enough borrowers to lend. So there's a competition among the banks to lend in the United States and so many other parts of the world because of the quantitative easing. Now you try to tighten monetary policy in this environment. Bankers are so willing to lend, but the central bank is trying to tighten monetary policy. It's not going to happen very easily. In fact, if you read regional Federal Reserve reports called Beige Book, they are saying that some bankers actually relaxing their lending standards so that they can lend more. So the Fed is tightening, commercial banks are relaxing, and we're not going to get much tightening as a result. And in that environment, the Fed might actually need to reduce asset prices to discourage people from spending money. It's the so-called negative wealth effect. Because otherwise, just raising interest rates might not be enough. And in the current environment, with inflation rate, for example, in the United States at 9.1%, the real rates are negative, something like negative 7%. So it's very difficult to discourage people from borrowing. especially when the bankers are so willing to lend. And so how do you tighten monetary policy and slow down the economy in that kind of environment? They might actually have to discourage people from buying by pushing asset prices lower. And so one of my fears is that central bank might not come to the rescue of the market, even if the market goes down, because that may be the only way for the central bank to slow the economy down.
This is one of the benefits of doing a VODCAST. People can see what we're talking about. So if you are listening via audio only, we encourage you to turn on the screen now so that you can see what we are talking about. But for our listeners, we will also talk you through the data. Richard, with every recession in the past 60 years, it has been predicted by an inversion of the yield curve between, if we look at, say, the 3-month and the 10-year Treasury. What's happening now with the yield curve?
Well, it's beginning to flatten. It hasn't completely flattened or inverted yet, but the fact that short terms are beginning to reach the level of the long-term rates suggests that quite a few people are beginning to believe that we might run into a much slower economy going forward. And that means slower inflation rate. And this whole inversion argument is that if the economy is slowing down, inflation rates will come down, and therefore long rates will not have to be so high. The fact that it is staying at 3%, and some weeks ago it was actually as high as 3.5%. So the fact that 3.5 came down to 3%, went a little bit below 3, suggests to me that markets are beginning to take Jay Powell seriously. That he might actually succeed in containing inflation and regain its credibility as an inflation fighter.
So Richard, this chart shows that the U.S. households saved a record amount during the pandemic, and they've been saving for a while now. Why is this chart so important to you?
What this chart shows is that the green parts is how much they saved, and the gray part, the gray part goes further down, that means how much they borrowed. And when you look at this chart, you notice that during the bubble days, U.S. households were actually net borrower, not net saver. Americans were saving so much. We all thought Americans loved to borrow money, but the opposite actually happened, and it's happening all the way to the present. And I said earlier that this is different from the 70s, because in the 70s, if interest rates are this low, you would think that they'd be borrowing massive amounts of money. But even today, this chart shows that U.S. household sector is still a net saver, even at zero interest rates. That means many U.S. households are still not very comfortable with their balance sheets. Otherwise, they should be borrowing more. So as long as that is the case, my guess is that interest rates will eventually come down to more reasonable levels, and inflation rates will eventually come down to more reasonable levels if the U.S. household sector remain this way.
That's an interesting observation. And even with record low interest rates in the U.S., non-financial corporations haven't been borrowing either for decades. Why is this something to watch out for?
Well, this is even more longer term, and that is that if you look at this chart in the 70s, 80s, U.S. companies were borrowing money. So you see that the number is at the below zero. That's when U.S. industrial companies were still competing with the Japanese, still competing with other countries trying to build better cars or better appliances. But then in the 80s and 90s, they began to go offshore to Mexico, Southeast Asia, or working with the Japanese or Chinese or Taiwanese or whatever the case may be. And so they actually stopped borrowing money to do real capital investments at home. And that's why inflation never took hold during the last almost 13 years before this very last year, because there were no borrowers. That's the significance of this chart.
I see. Now, Richard, recent activity is showing that borrowers may be returning in the U.S. Why should this be a concern now?
Now, the Federal Reserve was trying to bring the borrowers back by lowering interest rates so that the economy will move forward, right? That was the whole purpose of a quantitative easing. And as a result, they put in massive reserves in the banking system. The amount is 3.66 trillion. That's a huge amount. But that failed to produce inflation because the borrowers are not coming back. But if you look at bank borrowings starting middle of last year, they began to pick up quite sharply. And because of this, if you are the Fed official and then bank borrowing suddenly pick up, which might suggest the borrowers are coming back, and then you have $3.66 trillion of excess reserves in the banking system, that means bankers can lend almost unlimited amounts if the borrowers show up. Then you are in for massive inflation, right? The amount, this 3.66 trillion in excess reserves, is 2,000 times larger than the excess reserves in the US banking system just before the Lehman crisis. 2,000 times.
Yeah. I always thought Americans had the reputation of, being buried under credit card debt. So it was surprising to me that they're not borrowing.
Yeah, these charts are really shocking to our conventional wisdom that both the corporate sector and household sector in the United States are not borrowing money at all. They're actually saving money. And that's why even with this huge budget deficit in the United States, we had such low government bond yield. We were all taught that if the government runs such a large deficit, yields should be much, much higher. And they all came down to such low levels because the private sector was not borrowing money. And that first happened in Japan. That's why I was able to predict what's going to happen in the United States, because the same pattern was observed on these charts.
Thank you so much for joining me, Richard. That was Richard Koo, Chief Economist from Nomura Research Institute. In summary, I think if we've learned anything from this discussion is that right now, the old rules don't apply. Tighter monetary policy used to be the instrument of central banks to tame inflation, but given how much QE was released into the system, weaning them off easy money may cause some sharp pains. You've been tuning in to episode 1 of I See Your Trade. I See Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade up to IC Markets. In our next episode, we will be looking at the big technology companies. Some have profits larger than the GDP of a small country. Are tech companies too big to fail? Thank you for joining us today, and we look forward to seeing you next time.